Thank you, everybody. We wanted to take the opportunity now to go over some questions that you have sent through on strategy and finance. This isn't exhaustive, but I think what we've done is kind of categorize the main buckets of questions and areas of focus that we wanted to talk to you all about today. First is cost efficiencies across the group. I mentioned this at the beginning, but I think one of the main focus areas for us is going to be looking at the shared services, at overheads, at the group level, and areas where there are duplications of costs and of services that we can take out. And at the same time, equally, there are a lot of opportunities for revenue efficiencies. And by that, I mean making sure that our teams from a sales marketing standpoint are focused on delivering the best possible product for consumers using all of the tools in our toolkit. And as Sean is now getting up to speed with the business and the opportunity, focusing on Julius Amplify and the app, what we're trying to do is make sure that the sales team are all working together and are aware of all of the tools, all of the opportunities that the company has, and not work in silos, to work as a group. And I think that's very important, and that will be a big driver of our overall growth, which is to say, providing services to clients, customers that encompass all of the assets of our group and bring out the best possible product that we can give people. And cash flow is an important part of that. As you know, we've got three different business types from a revenue standpoint. So we have the software SaaS side of things, which is the Triller app, Amplify, Julius. Those have different financial characteristics than Triller TV and BKFC. Those businesses tend to be more working capital tight, and they have longer leeways for investment and for returns. The good thing from our standpoint, when we look at the business on a 1, 2, 3-year basis, as we start to integrate more with Julius Amplify and the app, and work with all of the revenue synergies that we plan on doing, what you get is a smoother financial profile. So what you see in Triller TV and BKFC tends to be event driven. So you will see the business from a revenue standpoint and an investment standpoint really follow a cadence that will match the events of those businesses, which is very different from the software SaaS side of things. But as those two sides of the business come together and hopefully work together more, what we'll see is a smoothing out of the overall financial profile, which means that we are able to budget with more certainty, and we'll be able to inform and give everybody guidance on where we think those businesses are going as a group. And that really ties into allocation of capital. As I said, there's different investment profiles for these businesses. The app, Amplify, Julius, the opportunity for those businesses is huge, and we're very focused on that. There's a lot of investment and focus that is going to be on marketing, brand awareness. These are things that will require a lot of upfront money and time, and which is different from the BKFC, Triller TV businesses, which are working capital intensive in a way that the software business isn't. But I think right now our focus is making sure that we've adequately capitalized the app and everything to do with that opportunity. And at the same time, we are and will remain focused on Triller TV and BKFC, which are core parts of our business. And that really dovetails into capital raising. So when we think about capital raising, as we've said, the friends and family we expect to close shortly. We then plan on doing a broader public marketing in probably Q1 or Q2 of next year. And I think what we're finding as we talk to more and more people, there are some people who are very interested in different parts of our business. So the BKFC, Triller TV, and then the app have different growth profiles, different risk rewards. And I think what we're seeing now, and actually one of the benefits of having all these conversations, is we're able to understand from a shareholder standpoint who is interested in which part of the business, but it will also give us the opportunity to explain how everything fits together and hopefully makes it far more kind of attractive from a shareholder return standpoint. And then when we think about how we're capitalized for our overall liabilities, we've done a lot over the past 12 to 18 months to equitize a lot of the instruments that were on our balance sheet that were equity or equity linked. So a lot of the convertible notes, we've had a few liabilities which were equitized, so that has helped. And I think going forward, as we have pointed out in the merger, we set up a share reserve, which is really meant to settle liabilities from the legacy Triller Group. And we expect to be deploying that over the coming months. So that will alleviate some of the near-term cash burn. Also, as Wing Fi mentioned, we do want to settle or resolve as much of our litigation as we can in a thoughtful way. We are aware that now that we've finished the merger, we have a different shareholder base. Clearly, we have a different stakeholder base. And from a governance standpoint and operating standpoint, our relationship with a lot of the different players in the litigation aspect is different. And we have an opportunity now to engage with people and try to resolve a lot of these litigation matters in a way that, frankly, we weren't able to do last year. And then when do you think Triller will make money? So we are very focused on, obviously, growth. We want to have profitable growth. Our expectation is once the app has, and Sean has really finished the strategy for rollout from a branding standpoint for the app and also marketing, our goal is to be cash flow positive by the end of fiscal 2025. And that will be in large part from contribution from Triller TV and BKFC, but also from the cadence of profitability of the app. And our focus is obviously generating revenue, not just from advertising, but also from e-commerce and from social selling. Both of those kind of revenue streams have different profiles and are more profitable in the near term. So I think that's going to help and be a tailwind for us as we move through fiscal 2025. We still think the best way for our shareholders, for us to grow shareholder value, is to invest in the business. We're all here for the same opportunity. The app is a huge focus for us. We're all very excited about the opportunity. And I think from a capital standpoint, our plans will be certainly over the next year to continue to deploy capital in those areas. And I think we are not focused on dividends. From an ROI standpoint, we think the best way to achieve that is still investing in the business. On share buybacks, this is something that as a board and as a company, we have to consider those things on a regular basis, and we will. I think as our share price and our liquidity profile changes, that's something that we would need to consider on a case-by-case basis. But as of today, that's not something that we are focused on, certainly for the near term. Just continuing on through the questions, some of these are IR focused, but obviously touch on finance. The first is, why wait so long to bring out information? And I think a lot of it has to do with the path we chose and the way in which we went public, which was not a traditional IPO. And as Wing Fi mentioned, what you would normally see in those situations is a book build and a lot of back and forth with investors and funds with a specific, timeline and kind of cadence. What we did is when we completed the merger, all those things happened at once. And so we found ourselves in a position where we were public. We had two different shareholder bases, and we started the communication as soon as we could, being mindful of the fact that we have SEC overall disclosure requirements that we have to be mindful of. And we are also in a period of doing registrations for for our internal chairs for the RSUs and other registrations. So all those things meant that we just had to be very careful about how and when we disseminate information. We view this as the first step. This is the first opportunity we've had to talk to everybody on an equal playing field. And our plan is to obviously build on this. And that goes into how we rebuild trust. We are very conscious of the fact that we have a large, disparate, in some cases, shareholder base with people who are loyal, who have invested in and been part of our journey for, in some cases, years. A lot of people are retail or maybe smaller, funds. Everybody is super important to us. Everybody is treated the same. And I think as we go through and give more information, communicate, which will include doing roadshows, targeted meetings, we think that is the best way to rebuild trust, by being transparent and giving measurements, giving goals, giving financial measures that we expect to be measured on. And that's something where in the coming weeks, we will be putting out more detailed financial metrics and goals as far as our key operating metrics. And I think that's really important because we want to make sure that everyone is part of this journey and that everyone has the information that they need in order to make a decision and feel like they are part of the journey. And again, that includes roadshows, that includes going out more widely, and also frankly talking and engaging with the sell side community. We've had a number of very promising conversations. We think we are a unique story for people. We fill a niche, and from a sell side standpoint, we are very encouraged by the demand that we've seen. So we expect that to be a key part of our toolkit as we go out to the broader market. And then just talking about priorities for the group, as I said, we kind of touched on, we plan to communicate, we plan to listen, and we plan to give transparent goals, financial metrics that everybody can see and obviously measure us on. That's important. Yorkville, that's an ongoing matter. As everyone has seen, we've made filings about it. We've made all the disclosures. I think for Yorkville, we have to be mindful of the fact that we can't really go into too much detail from a company standpoint, other than we want a resolution as soon as we can that benefits everybody and allows the company to move on and just not focus on the distraction. It is something that clearly is taking time and does take time, but we want to resolve that amicably. And Jerome could talk about the fintech side of things and maybe go into more detail there.
Great. Thank you, Mark. For our fintech investments, we've been an active investor in the fintech industry for many years. We've always taken the perspective that it will help us from a financial as well as strategic perspective. We've had investment in a digital wealth asset management platform that we successfully monetized after the business grew substantially. We have ongoing investments at the moment into a digital bank, into an e-commerce slash payment platform. And like I said, it's from a financial perspective and strategic perspective, this brings a lot to our business. It's always interesting to see what other companies are doing, what innovations we can bring to our own, in this case, our financial services business under AGBA. I think going forward, we have a broader business. That means that we have a lot of opportunities to look at other areas as well. And I think we'll be, well, as Mark said, we're mostly focused on developing our core businesses, but we will always keep an eye out and see if there's interesting ways to develop partnerships, investments, or outright acquisitions into areas that can complement our business. There are many exciting things that are out there. We don't always know the best way to do things ourselves, and these are great ways to bring in things that otherwise we wouldn't be able to do ourselves. A lot of people on our team have backgrounds in the investment industry, have close ties to be it venture capital in, or private equity or other areas where we're presented with a lot of opportunities on an ongoing basis. So we'll continue to look at those. In terms of allocating capital to those investments and key drivers for making decisions around that, like I said, I think the majority of our capital will go towards driving our own core businesses, and we'll be opportunistically looking at the things that we'll come across in terms of partnerships or investments or other opportunities. For the AGBA business, in terms of its business over the last few years, I think it's fair to say that it's had its share of challenges. And where we are today is we believe that we've come through a difficult period as a more flexible, focused, and strong business. We are very excited about the opportunities that lay ahead. We think the business can be cash flow positive by the end of 2025. And I think it's an important part of our group, as Wing-Fi has outlined in another part of our presentations. We see a lot of overlap and opportunities in the medium to long term as we bring together social media, social commerce, and fintech or social finance, whatever form that will take. There are many exciting things that we can explore. So AGBA is an important part of our business, and I think it will be for the foreseeable future.
I just wanted to say thank you again for everybody for submitting questions, and we encourage you to continue to send through questions as we build the dialogue here. Please send any questions through to ir@triller.co. Thank you.